Hey everyone, and welcome to The Explainer. I am so thrilled you're here today because we are going to unpack one of the most fascinating, powerful, and honestly kind of misunderstood corners of the financial markets. Today, we're completely dissecting the anatomy of a futures contract. Now, if you've ever looked at the derivatives market and felt like it was just this impenetrable wall of numbers and intense jargon, trust me, you are not alone. But here's the secret. Beneath all that complexity, it's actually a highly structured, wonderfully logical machine. So today, we're going to take that machine apart, piece by piece, look at the gears, and show you exactly how it ticks. By the end of this explainer, you'll see that understanding futures is really just about grasping a few basic building blocks. Okay, let's dive right into this. Here is our roadmap for today. We'll start with forwards versus futures. Second, the underlying asset. Third, lot and contract sizes. Fourth, margin and leverage explained. And finally, futures in the real world. All right, kicking things off with Section 1, forwards versus futures. To truly appreciate the modern futures market, we actually need to take a quick step back in time. We kind of need to understand the historical context of why futures were even created in the first place, and that means looking at their predecessor. Before futures, we had what are called forwards. Now, you can think of the forwards market a bit like the Wild West of finance. It was largely unregulated. If a buyer and a seller wanted to exchange some commodity for money at a later date, they just made a private agreement between themselves. But you can probably guess the massive risk there, right? What if one party just walks away? What if someone defaults? To solve this whole mess, the financial world evolved and created futures. In stark contrast to forwards, a modern futures contract is highly standardized. The rules are literally set in stone. And more importantly, there's the presence of a strict regulator and an exchange. This regulator basically acts as the ultimate referee. They ensure that any intermediaries are doing their jobs properly. And, crucially, they guarantee that all financial obligations are actually fulfilled by both the buyer and the seller. Nobody just gets to walk away. Moving right along to Section 2, the underlying asset. So, now that we know we're operating in a safe, regulated environment, we can move to the absolute foundation of our anatomy lesson. Before you can trade, well, you have to know exactly what it is you're trading. Everything in the futures market derives its value from something else. I mean, that's literally why they're called derivatives. That something else is the underlying asset. This foundational piece can be practically anything of value. It could be equity shares in a company, a physical commodity like gold, a currency pair like the US dollar and the Indian rupee, or even a broad market index like the Nifty or Sensex. And I should note here the current real-time price of this underlying asset in the regular market is often referred to as the spot price. Why? Well, because if you buy it in the regular cash market, you're exchanging money for that asset right on the spot. So the crucial takeaway here is this. Every single futures contract in existence is built entirely upon this base asset. If you're trading Infosys futures, the underlying is the Infosys stock. If you're trading gold futures, it's physical gold. The underlying is the anchor. It gives the contract its whole identity and completely dictates its price movements. Okay, on to Section 3, lot and contract sizes. Let's see how this builds. Now that we've firmly established the what of our trade, we have to look at the how much. In the regular stock market, you have total freedom, right? But the futures market has very specific rules about volume. And this brings us to the concept of the lot size. A lot size is basically the minimum fixed quantity of the underlying asset that you are mandated to trade in a single futures contract. Remember how we said futures are highly standardized to keep things orderly? Well, this right here is a prime example. In the regular equity market, if you want to buy just one single share of a company, you can totally do that. Not in futures. In futures, you are locked into standard lot sizes defined by the exchange. I absolutely love this analogy because it just hits the nail on the head. Think of it exactly like buying soda at a massive wholesale warehouse store. You can't just walk in, open a can, and buy one sip. You can't even buy just one can. You have to buy the entire 12-pack or the 24-pack. That pack is your minimum lot. If you want more, you have to buy two 12-packs or three. It always works in multiples, and it's definitely worth noting that these exchange-mandated lot sizes, they aren't just random, and they aren't permanent forever either. The exchange actually reviews them periodically throughout the year and will tweak the lot sizes based on how the underlying asset's price is fluctuating. So, how does this lot size translate into actual money? It's simple visual math. Let's walk through it together. Step 1. You find the current price of your underlying asset. Let's use Infosys stock again as our example. Say it's trading at a spot price of roughly 1702 rupees. Step 2. You check the exchange rules to find the mandated lot size for Infosys futures. In this case, it's 600 shares. Step 3. You just multiply them. 600 shares multiplied by 1702 rupees. When you do that math, you get a total contract value of over 10 lakh rupees. That is the massive total size of the contract you are stepping into. Which brings us to Section 4, Margin and Leverage Explained. Now, if you're sitting there thinking, wait a minute, I don't have 10 lakh rupees just sitting around to buy one contract. Don't panic. This brings us directly to the most exciting, dynamic mechanic of the whole futures market, how you actually pay to get into these massive positions. Welcome to the concept of margin. Margin is simply a specific percentage of that total massive contract size that you must pay upfront to enter the trade. It's basically a minimum amount of money that gets blocked in your account. The absolute beauty of the futures market is that you do not actually need to pay the total contract value to get into the trade. And remember our earlier talk about safety and regulators? To ensure nobody defaults, the exchange requires both the buyer and the seller to put up this margin up front. Let's make this perfectly concrete with a genuinely mind-blowing scenario. Let's say the exchange decides the margin requirement for a particular asset is 10%. If your total contract size is 10 lakh rupees, you only need to put up 10%. That means a trader only needs 1 lakh rupees in their account to control an asset worth 10 lakhs. The other 9 lakhs, you don't have to put it up at all. It's like you're controlling a massive mountain with just a handful of rocks. And this brilliantly illustrates the concept of leverage. You see, margin is the upfront deposit, but leverage is the superpower that margin unlocks. Leverage is what allows you to control massive assets with a mere fraction of the cost. It dramatically amplifies your financial footprint in the market. By only requiring a blocked minimum amount, traders can execute strategies that would be utterly impossible for them to pull off in the regular cash market. Basically, margin is the engine, leverage is the incredible speed it gives you. Finally, let's wrap up with Section 5, Futures in the Real World. So, we have the theory down, we know the anatomy, we know about the underlying asset, lot sizes, contract value, and the absolute magic of margin and leverage. Now let's step out of the classroom and look at some actual market examples. What's really interesting about this slide is it proves our earlier analogy. It's the exact same skeleton, just wearing different skin. We have 3 completely different asset classes here. Nifty is an equity index. Dabor is an individual corporate stock. Gold is a physical commodity. They are worlds apart in reality, right? Yet in the futures market, their mathematical structure remains absolutely identical. For Nifty, the lot size is 50. You multiply by the price, and your margin is about 1.1 lakhs. For Dabor, a massive lot size of 1250 multiplied by a smaller price of 646 requires a margin of about 1.42 lakhs. For gold, you're trading in 1 kilogram lots, and the margin required is around 4.2 lakhs. The assets themselves change, but the anatomy, the lot size, price, margin, that structure never varies. But within this rigid structure, there are some really fascinating quirks based on human behavior and macroeconomics. Let's look at a quick micro-narrative within the currency derivative segment, specifically the US dollar to Indian rupee, or USD-INR contract. The exchange looks at currencies and says, well, currencies don't wildly swing 5 or 10% in a single day like a tech stock might, right? They are relatively highly stable. Because the pricing is so stable, the risk of a massive sudden loss is much lower. And because the risk is lower, the exchange requires significantly less margin to guarantee the trade. Which leads us to this shockingly low number. To control a standard currency contract of $1,000, a trader's margin requirement might be a mere 1,810 rupees. Think about that for just a second. With less than 2,000 rupees blocked in your account, you are directing the financial equivalent of $1,000. It is a showcase of extreme, pure leverage at work, all made mathematically safe by the low volatility of the underlying asset. And that brings us to our ultimate reality check. The structured anatomy of a futures contract is a modern marvel of finance. Standardized lots and margin requirements unlock this whole world where a really small amount of capital controls an enormous amount of wealth. Leverage absolutely lets you punch far above your weight class. But remember, the math works in both directions. It amplifies your reach, for sure, but it also amplifies your risk. So as you look at these incredibly powerful financial tools, the final question you really must ask yourself isn't just about how much you can lift, but rather, are you prepared for the swing back? Thank you so much for joining me on this explainer, and I really hope this has helped you see the elegant machinery behind the futures market.